Hello and welcome back. This is Kevin Prince from BMO Exchange Traded Funds, and we're so pleased to have you one more time join us for our weekly web show on market insights. And I'll just quickly highlight to everybody again, this show effectively for most people is about insights in the marketplace, and we provide it every week, these Fridays at 1 o'clock, and we'll have it again next week, of course, too. Quick thing I'll highlight to everybody out there is I have some new guests today. So I'm going to highlight that we now have Travis Robertson from the S&P 500 joining us on this week. And I really appreciate that having S&P for the last two shows, and this will be their third and final show with us. Really appreciate their participation with us. And I should say that's the S&P Dow Jones Indices across the board. Again, like in normal shows, we're going to take the next 30 minutes and dive into some market insights. Specifically, this session, we're going to talk about active and passive, and really some investing myths around ETFs and passive investing across the board. And then thank you for all those participants out there that sent some questions in advance. Those questions really helped us to really build some additional content for you today, and we'll go through those at the end there. With that, let's get going. Just some key disclaimers for everybody out there. And of course, really when we say through the disclaimers, what we're really highlighting here is effectively, this is not advice, but it really is more market insights out there for you. Thank you for that. And I'll skip through those. And the other thing I'll quickly highlight too for everybody out there, think about when you go through these sessions, this is really designed for educational purposes across the board. All right, with that, we have Travis Robertson today, as well as I should highlight, we also have Mackenzie Box joining us today from BMO Global Asset Management. She's one of our senior product managers, and she's going to dive into some of the individual questions on and topics around ETFs too. So with that, let me first hand it off to Travis. Travis, I mean, your firm does a lot of work out there, especially in research in the marketplace in regards towards indexes and performance of respective indexes out there. Can you do me a favor? First, highlight that, and then second of all, highlight where the listeners of this show can turn around and find that information on a regular basis.
You bet, Kevin, and thanks for having me today. It's a pleasure to be a part of this webcast. And really just to start at the very top level of this trend as a whole, and why S&P creates the SPIVA scorecard and does the research we do. A big piece of that is over the last 20 years of my career, really, I've watched it firsthand unfold that investors more and more are incorporating passive index tracking vehicles or investments alongside their active management strategies. They're using them to complement them. They're blending the two together. And we, S&P Dow Jones has been in the scorekeeping, call it benchmarking, if you will, business for almost 140 years, right? The Dow Jones Transportation Average came along in 1885, and the S&P 500, as we know it today, came along in 1957. So we've been helping stock pickers track their benchmark and measure that universe for a long time. But for the last 20 years or so, we've been calculating a much more robust scorecard called SPIVA, and SPIVA stands for S&P Indices versus Active. Now it's not as adversarial as it sounds. Again, we've been helping managers keep score for a long time, and what we did with SPIVA is we built it to be a tool to identify where is there opportunity for active management, where is there opportunity for index-based solutions, and how to keep count of what's working and what's not, and in which categories. And so you can use it in a number of ways, and I'll touch on that. You're just going through this infographic we have here on the slide presentation. This is a summary of our SPIVA results, which is a semi-annual report. We put it out twice a year for all of these markets. So it's a summary of the results in the US, Canada, Australia, Japan, Europe, and measuring the 1, 3, and 5-year percentage of funds underperforming their benchmark. Now, the SPIVA difference from other benchmarking studies, really the big differentiator relies on a few things. One, and most importantly, is we work to eliminate survivorship bias. And so we work in the US, we work with the University of Chicago to access their CRISP database, which captures all the managers in that universe over the last 19 years that we've been doing the study, and gives us, and as those managers merge or liquidate, helps us keep those the results in the data. And then the other thing we do is a lot of manual work to make sure that we're properly fitting the managers that belong benchmark to the Composite or benchmark to the S&P 500 are in the right category and giving a fair shake. And so you see here the results. If you zoom in on the U.S., the right number on the far right number, 81%, is the percentage of managers underperforming the benchmark over the last 5 years. And I'll get more to what those results look like over the long term. But what you can see here is there's quite a bit of consistency around the world and how challenging it is, especially in large cap funds. But also, you just have a data set here now to think about your portfolio and the pieces of your portfolio and how you're going to blend those all together.
And that's available on your website for those people out there. That's your spdji.com/SPIVA for anybody who wants to get access to not only this infographic, but all the detail behind all these.
Yeah, the scorecards, the research reports that come out with it, they're all free resources for investors and financial advisors and financial professionals. They can access at any time at their leisure.
Thanks for that. Actually, Mackenzie, maybe you can dial in here for a second because we're about to talk about some terminology. I just want to clarify terminology. So can you help us here in the passive and active terminology we're about to go through?
Yeah, sure. And thanks, Kevin, and thanks everyone for joining. So first, just setting the stage and defining active and passive. So when we look at passive, we look to investment vehicles like ETFs, which generally track an index or follow a strict set of rules. And generally, this is a great solution for fee-sensitive investors who are looking for market exposure. Whereas active is really where security selection is done based on high conviction stocks, which are generally determined through fundamental, systematic, or technical analysis. And these are solutions geared more towards investors who are, more return focused and maybe believe that markets are a little bit less efficient.
And that's a good background there. The other thing too, I know you brought forward some research into this slide, and this is key. Some historical research, been around for 20 years, and it's been not really challenged out there because it's been basically set in stone now. Maybe Mackenzie, you can walk through us the research and what that really means and the importance of asset allocation.
Yeah, so I think, whether you choose to go active or passive, asset allocation is really a key for any portfolio. Really looking at portfolio volatility and overall performance. And as Kevin alluded to, there's been multiple studies in the industry around asset allocation, more famously one stating that 91% of the volatility in a portfolio actually comes from the asset allocation. So not security selection or market timing of picking a particular stock. And then that was later followed up by another study that outlined that 100% of the performance comes from the asset allocation. So, asset allocation is really key when you look at lowering risk and enhancing your returns. So, whether you go passive or active, it's about asset allocation and not security selection. So, actively changing and rebalancing your portfolio can really help, your portfolio over the long term and take advantage of, short-term market movements.
Such a key point, absolutely such a key point, because that asset allocation can't be understated. And I think we're going to come back and touch on that a little bit later on, but thank you for highlighting that. Mackenzie, just staying with you for a second here. Now, the context of some understanding out there, we've certainly heard from feedback from individuals from time to time about passive or ETFs, in this case, the passive ETFs, being a little riskier than stocks or funds out there. Maybe you can briefly talk to that before I hand it off to Travis to go a little more detail.
Yeah, and I think that's something we often hear, in the industry. One thing that commonly comes up is that, ETFs are riskier than stocks, but, in reality, ETFs really provide, greater diversification because they're giving you exposure to a basket of securities as opposed to just getting a single stock. And when we actually look at the numbers, you do see a little bit less volatility in the broad market. So just looking at the slide, we compared the S&P 500 to, the U.S. equity funds in Canada, and you do see slightly less volatility in the market, the broad market, and that's really just because you're getting that diversification to a basket of securities over a single stock or a highly concentrated portfolio. Thanks.
Yeah, that makes sense. Now, Travis, certainly there's been market corrections in the past, and so if we take a look at risky passive indexes, maybe you can speak to the performance of the more known indexes out there and how they performed in the past in those market corrections. And you've put together a bunch of key ones here, so speak to it if you can, please.
Yeah, you bet. And really builds upon Mackenzie's comments because, one, we see that indexes, right, broad-based indices tend to have less risk because they're more diversified. But then there's the argument, and this is to your point around downside protection. Then there's the argument by some stock pickers that they'll protect the downside by picking more defensive stocks or doing, their best picks will stand out and outperform in those down markets. And so if you go back and look at specific periods, 2008 being, until what we've experienced this year, 2008 really stood out as that last big drawdown. And going back to that period, you see here the summary at the end of 08, they're in the middle of that table. The one-year results were that total market, 70% of managers had underperformed the benchmark, 54% of large cap managers, 75% of mid caps, and 84% of small caps. And these are the big benchmarks for U.S. equities. The managers in each of those respective categories had underperformed. And really the one bright spot had been large cap value managers. And when we decompose that performance and looked even deeper into it, the way they often outperformed was through going to cash. It wasn't stock selection as much as back to asset allocation. So active investors were paying active managers who were moving in and out of cash, and they were paying for stock picking. And a lot of times, investors do some of that on their own, or they work with a financial professional to do that. So not necessarily their active mutual fund manager. And so again, it just shows how challenging it is. 2000 to 2002 was similar. And then the fourth quarter of 2018, there was a big reversal in the market there at the end of the year. And when we looked at that period, the almost 70% of domestic equity funds had lagged the 1500 during that full year. So definitely dispels the myth that an active stock picking strategy, as a group, they're more defensive than the index that underlies an ETF.
Yeah, and I think as you mentioned before, there's value in both across the board.
Yep.
Mackenzie, turning to you for a second here, let's talk about some other concepts here about stocks and ETFs for that matter outperforming in this case. So give us some just key understandings here of ETFs and that misunderstanding sometimes that ETFs may not outperform in various marketplaces, and highlight that if you can, and give us some insights of active and passive in that too.
Yeah, and I think active management can really play an important component in a portfolio, taking advantage of market conditions and delivering, outperformance, but it can be challenging to do so, consistently over time. So generally we see active managers focusing more on risk-adjusted returns by selecting higher quality stocks, whereas, ETFs can normally outperform when the entire market lifts and when you consider fees and adverse stock selection impacts. So really, ETFs are kind of that consistent long-term outperformance that you'd be looking for.
Oh, good to highlight the risk-adjusted returns too. Appreciate that. And then Travis, going to you, take a look at performance in the various market conditions, passive in those respective market conditions. Maybe you could talk to this.
Yeah. Yeah. And really, this is a summary of a lot of what we have been speaking about here that, it doesn't necessarily, you can't draw a strong correlation between when active will at work or won't work. Maybe it's more about finding those rare active managers that really stand out. And of course, you hang on to those. And then when you're using a passive strategy, when you can't find that manager that stands out, you have the passive strategy to implement. And so when we look at the large cap managers, U.S. managers, so in that 500, the total U.S. manager data set, what you see here is we broke the market down back to 2001 when we started this analysis. We broke the market down into strong markets, moderate markets, and bad markets, and you can see that there's not a big win for active or passive, or just passive all the time in any of these periods, right? So 66% of the time, if you're in a strong market, the active managers are underperforming the benchmark. Maybe moderate's the one place where active starts to really edge out, but not by much. And of course, back to our point that in bad markets, it's your ETF and your index-based solution can still work just as well in a down market as it does in a strong up market.
Thanks for that, Travis. And actually, stay with you for a few more seconds here. You did some historical analysis here too, and more specifically, you went beyond the broad markets. You started bringing in some small caps too, for that matter, mid caps too. So maybe you can talk about this too, as in the context.
Yep, you bet. And we've heard that as well, that large cap is efficient, and so that's where it makes the most sense to index, but small and mid caps are less efficient. And actually, if you look at the longer term data, 5 years, 10 years, 15 years, it actually goes the other direction, and you can start to see at the 5-year mark that shift is happening in this data set here. And so on the far right of this table, you see the total market after 5 years, 83% of managers were underperforming. Large cap, it was 79%. Small and mid cap, you were 55% and 68%. When you get out to 15 years, those numbers move up north of 80%. And so interestingly enough, what we observe is smaller cap can be just as hard, if not harder, for active managers to outperform. And then the more time that goes by, the harder it gets as well. So the 1-year results can move around quite a bit. And we see that every year from year to year. Short-term results move around, but when you start to compound the longer term, the trend that's in place and this data, when you get out to 10 and 15 years, it gets really tough to find a manager that's going to stand out over that long of a track record. And again, it's not just about the only way to go is passive, and this is the evidence for only passive. It's also evidence that, again, when you have a good active manager who does stand out over 10 or 15 years, that's really unique and valuable to find. And so that's where we see the blending of active and passive together, because when you get down into asset allocation and you look bucket by bucket, you now have a bigger toolbox than ever between ETFs and funds to build portfolios. And we're just trying to provide you the resources to do your homework, to be educated, to have the most education and the most the most resources at your disposal.
Yeah, I like that point. I really like also the point, the blending too, because the mixing the active passive can make a lot of sense for short term and long term. I'm going to come back to that in a second. Before we do that, I want to touch base with Mackenzie. And Mackenzie, one of the critiques that sometimes we see with the respective SPIVA data sets out there is, it doesn't factor in the total cost because that's a benchmark and it's not specifically investable. But of course, the ETF makes those benchmarks investable. So maybe you can talk to that a little bit. And I know you put together a nice little chart here that really speaks to it well. So I'll give it to you.
Yeah. So, I mean, if you're wanting to see, a broad market comparison, in the slide I included our ZSP ETF, which tracks the S&P 500. It has a management fee of 8 basis points. So that's all taken into account. But on any provider's website in Canada, you can generally see this performance information, and we update it daily. So, you can actually see that over time, you really are getting the performance of the index. There really isn't a significant difference. And the other thing to highlight too is on our website, we also highlight the daily holdings. So, you're able to go in and actually view the underlying and understand what the ETF is holding.
Well, it makes sense. I mean, if you're holding all the things in the S&P 500, you should perform like the S&P 500. Kind of makes sense. You're right, but at least you can check it. Mackenzie, just staying with you a bit more, because Travis kind of highlighted the blending of active and passive. And I think that's an interesting conversation, right? It's kind of more of a hybrid approach, and there are benefits of mixing the two of them together. Maybe you can talk to that in a little bit more detail here.
Yeah, and I think we touched on some of the myths, but I think it's really important to understand that active and passive can really play a role in any portfolio, and employing a blend of both. You can add discipline through passive vehicles like ETFs, and you can for your active component you can remain tactical and take advantage of various market opportunities. Whether you want to kind of build a portfolio, with a passive as your core, and some satellite active funds on the side, you kind of have that flexibility. And if you're looking for certain exposures, you can kind of tilt your portfolio that way. But I think really, blending them together gives you, the best of both worlds. You can have that long-term outperformance and also take advantage of, some of the market movements as well, being a little bit more tactical.
Thanks, Mackenzie. Travis, going right back to you. Some good math here, and I want to make sure we're highlighting the math here too, because I know your team does a ton of research. So talk to us about the statistical importance of the median and the average out there when you're looking at the skewness of the S&P 500.
Yeah, that's a mouthful, right? And I'll share the punchline before I try to explain the slide, because I think the implications of this slide and this histogram of data here are really big for building portfolios and blending active and passive together. And the punchline is the returns driven that we experience in stocks and equities are driven by 3 to 4% of stocks in the overall universe. So a small amount of stocks are responsible for the majority of the return that you get in a stock portfolio. So let me walk you through this. This bar chart is a histogram where we've tallied up the cumulative return of all the stocks that were in the 500 over 20 years. And you see in the first two bars on the left that roughly when you combine those amounts, those percentages, you get just north of 30%. So roughly 1 in 3 stocks were negative on a cumulative basis over 20 years, which is surprising. That many stocks in that data set, nearly 1,000 stocks, would have been negative cumulative over 20 years. And then the median return was just 42%. So half the stocks in the data set made less than 42%. And so the other way to look at that is you could have laddered GICs and made more than half the stocks in that data set for the 500. Now the average stock return was 179%. And so Kevin, you mentioned positive skew. That's what this chart shows, is that much higher average than median, kind of stretched over to the right, is driven by those few stocks way out on the right that were up over 1,000%. And this speaks to diversification, right? Because if you didn't own a meaningful amount of those few stocks, or any of those few stocks, you probably underperformed your benchmark, and that makes stock picking really hard. And then for the really, really good managers, that's where they probably pride themselves, is going out and finding those names. Now, what's surprising about stocks that are out there on the far right, yeah, you'll find Apple out there, but you'll also find companies like Domino's Pizza and Monster Energy, names that you would not expect in today's environment to be those that drove returns. And on the next slide, Kevin, we actually did the same for the composite. And you see here, it's even more exaggerated, because half of all stocks were negative. The median was negative 5%, but yet you have a much healthier average cumulative return over 20 years. And again, it's those few stocks way out on the right. And for anybody that's curious about going down this rabbit hole, following me down this rabbit hole, feel free to Google Professor Bessenbinder at Arizona State University and his research paper. It's a big one, But he does nearly 100 years of analysis of all the U.S. securities, and it's the same results, the same chart. Small percentage of stocks drive your equity returns over the long run. And this just all comes back to the value of diversification, the value of blending strategies together so you don't have those big holes in your portfolios.
Oh, well said. Well said. Hey, Mackenzie, just because we're talking about some myths here, one thing that I always hear about, maybe you can help us out through this, is that ETFs themselves can move the marketplace. And I know there's some recent research that came up from Scotia Bank here. Maybe you can highlight what that research kind of brought forward to my attention, your attention for that matter.
Yeah, and I think that is something that we hear often in the market. In reality, ETFs do not move the market. They move with the underlying securities. So if there is a market event, or like we've seen in the last couple of months, ETFs really do move with the underlying securities. And one point I like to make sure is clear is that ETFs reflect the price of the underlying securities and not the other way around. So if you look at the chart here, you can it's interesting looking at the ownership. So just looking at the financials, Canadian financials, ETFs own extremely minimal amounts of the Canadian banks. And if you actually look at that, is that enough to move the market? No, because it's such a fractional amount. So when you're looking at these, you really have to just think that the ETFs move with the securities, and that's really the key to this.
Yeah, I mean, it's a good chart. I'm so glad that Scotia put that together just to highlight that the fractional ownerships of ETFs in those respective banks really shows that it's pretty hard to move the market from an ETF perspective. We're participants. We're not going to drive the market. Hey, let's shift gears here and let's talk a little bit about the questions that came in this week. And thank you again for everybody taking the time and effort to send us a question. First one came in on more of the ESG topic. So there's a report that came out this week that talked about performance in ESG in these markets. Mackenzie, maybe turn to you, and can you comment on that, please?
Yeah, so I think the current market stress from March and now the recovery is really a proof point for ESG, and by and large it has outperformed. Recently we've seen energy come back, and looking at that, ESG is still doing quite well, which I think really highlights the quality of the portfolio. And I think the other thing really to highlight too is that, investors are recognizing, the impact of corporate incidents, and, there's an influx of investors who are wanting to invest in ESG, and, it's proving that, performance is not an impediment. Performance is actually quite strong in ESG. And I think as, education in this area continues to grow, and the measurement of ESG continues to progress, I think we'll continue to see lots of interest and focus around ESG focused products as we look ahead.
Yeah, good to highlight that. I think that's really something that more research is going to come out, but I saw that good research too, or focus on the governance in the marketplace being that key differentiating factor, especially good companies, good governance. I get that as a point. Travis, actually going to you, a good question came in as a follow-up from last week. Why do investors use the S&P 500 as a benchmark? And can you give me a quick difference between the S&P and maybe the Dow Jones across the board?
Yeah, you bet. Well, the one thing that's important to understand about the S&P 500 as just those 500 names in the U.S. out of a few thousand stocks down here, is that one index captures 80% of the overall U.S. market. So it's a great barometer. It's the most liquid basket of stocks on the globe, and so it's very easy for asset managers like BMO to build an ETF, and then back to your guys' point, to track it and actually deliver the performance of it. So the 500, its ecosystem as far as derivatives is very big, and so makes it very useful. But the Dow came before the S&P. So the good question is why didn't the Dow keep its title as being the first index and the most followed index? And that's because it's price weighted. So the weighting within the index is driven by the actual price of the stocks. And so as Apple, with Apple at 1,000 and, the next name down maybe at $50, that's a very arbitrary thing because it really depends upon the number of shares outstanding and doesn't reflect the actual overall size of the company. And so the 500 instead is market cap weighted, and it reflects the size of the companies. And so Microsoft and Apple and these big, ExxonMobil, these big names are represented properly within the index to give you that exposure that correctly reflects the marketplace.
No, thanks for that, and I think that's a good way. I'll quickly highlight for anybody who wants to dive in a little bit more in the S&P. The replay of all these webinars are available online, and we spent a good topic last week diving into both the S&P and the Dow Jones. I actually went through the construction of each one of those indexes, and I think you're right. When you're looking at 80% of the underlying available investing market in the States, that's why people look at it as a broad benchmark, and the history too beyond it, of course. Mackenzie, turning to you, how does somebody access this? And I think it'd be a quick one for you to answer because I think you know this one off by heart. But how does somebody access the S&P 500? And then second part, of course, does it include the dividends?
Yeah, thanks, Kevin. Well, great news. BMO ETFs has a ETF that tracks the S&P 500. So we have ZSP, and we also have that in a US dollar form, which is ZSP.U. And then we also have a currency hedged version, which is ZUE. So depending on your view, there's multiple options for you. These are all total return, which includes the dividends. So you're getting the index return and you're also getting the dividends.
Because we pay that dividend out on a regular basis. As it comes into us, we're paying that out, of course.
Yeah.
Yeah, no, that's good to highlight that. So then, actually, Travis, I'm going to probably close off with you here. Little long question, so bear with me, right? Really what the individual is looking at, and it's a follow-up from last week's question. We certainly, last week's show, we talked about the S&P 500, the 400, and we talked about the 600. And then, of course, the investor is looking at the total market index itself, too, which is the 1,500 itself. Now, how does somebody decide their asset allocation? And then second of all, taking a look at, where do you put your money in that total return index? And a last, but of course, how does that active, because you're hearing about passive, but it's just active and it gets a little confusing. So maybe you can unbox that question a little bit and just go through it piece by piece.
Yeah, you bet. Well, if you're trying to define your asset allocation within equities, you can start globally at looking at, the total market cap globally of all companies, and then what should your weighting be to the US or to Canada, to Europe, to Australia, and you can slice and dice that in so many ways. But if we just go to the US and then think about the total market index, then the 5, the 4, and the 6, those are the components of that total market index. And so the reason many investors split those apart and don't just buy the total market is you can express your view on mid caps or small caps, whether you're constructive and bullish on one of those categories or you want to be defensive. So it allows you, by breaking them apart, it allows you to take a position and tilt towards the various asset classes. So you'll see an investor who wants to be even more conservative, maybe own more of the 500 than they would in the total market index, or somebody who wants to be more aggressive and has a longer time horizon may tilt towards smaller caps. And again, these are just those benchmark indexes for whichever vehicles you're using, whether it's the ETF tracking them or an active manager in those categories. And that again speaks to, whether you want to replicate just a category or think big picture. And then that last question there is an indexing kind of active in this passive conversation? And one big point here is, anytime you go away from market cap and you tilt towards mid cap, small caps, that's an active tilt. When you go away from the benchmark weighting at a country level, that's an active decision. So a lot of times what really investors are doing is they're using the passive building blocks to make active bets or active decisions around, that fit their thesis or their view on the markets.
Well, I think that goes right back to the slide that Mackenzie talked about at the beginning, is about that asset allocation decision, because really your ETFs are kind of passive tools, to really help you build that asset allocation. And developing that asset allocation, you're right, is an active decision. And that's a unique for everybody out there and their own investment portfolio. So that brings us to a close this week. I do want to thank everybody for taking the time to join us again for this session. I want to thank Travis, as well as the S&P 500, and I want to thank Mackenzie for joining us today. I want to highlight quickly the show for next week. We're going to have the NEO Exchange on next week. And what I like to highlight about that show is we're going to talk about the volume you cannot see, because there's a lot of volume in respect of ETFs, and for that matter, stocks too, that you may not be seeing. And we're going to highlight that and show it to you next week. So look forward to you joining us, and I look forward to you sending us some questions in advance next week at 1 o'clock Friday. Talk to you then. Bye now.